G'day, Ben Kingsley here with my economic update for November 2021. Some big themes this month. Why I think the RBA, along with the world central bankers, has an ace up their sleeve in tackling inflation. Adoption of vaccines is leading to safer economic reopening and sustainable reopening, which is exciting. And then also my other big theme around property price listings are surging, but is that the full story? So they are the big themes coming through in this update for this month. There is so much data to get through, so let's get straight into it. I've been starting these last couple of months with my COVID data updates, and it's going to be no different this month, because at the end of the day, the reopening is a result of reduced infections, reducing hospitalizations, and most importantly, reducing deaths, which also means great economic prosperity for all. So let's start with the global infections. We did see those numbers approaching 246 million COVID cases reported. Now that's up from 235 million that I reported last month. Sadly, total deaths are now over 5 million people. So reflect on that, everyone. 5 million people have lost their lives in this pandemic. So that is obviously terrible news. Total vaccinations administered at the time of recording are now closing in on 7 billion doses. That's up from 3.6 billion last month. And in terms of global population that is now fully vaccinated, we are now at 39% of the global population, and that's up from 35% last month. Now, the rolling 28 days is where we start to see the impact that the vaccines are having right across the globe. So let's start to think about those numbers. Total infections, are just under 12 million in the last 28 days. Now that's down 2.5 million from 14.5 million infections from the previous 28 days. And that's the benefit of the vaccine kicking in there. Vaccines administered in the last 28 days, over 610 million doses. Total deaths in the last 28 days is still a sad reading number of 197,000 people losing their life in the last 28 days. Now, on a positive note, however, that's down from 235,000 in the last 28 days or the previous 28 days. So there is improvement happening here. In terms of global case fatality ratio, is sitting at 1.68. Now, from the total pandemic, remember that was around 2%. So that is also coming down. So for every 100 people who are contracting the virus, sadly, still 1.68 people around the world are still dying. Looking at the Australian data, and remembering we're looking at this from a health point of view that rolls into the economic outputs and also the economic prosperity. If we can get people mobility safely, effectively, then obviously everyone benefits, and so does the economy. So the rolling 28 days, the fatality rate is running in Australia at 0.68 of 1%. Now that is increased slightly from the previous 28 days reading of 0.59. So you're probably asking, why is it that our fatality rate is gone up? Well, it's a simple answer to that, and that is when you start to look at the incidence rate. So we measure incidence rates per 100,000 people of population. What we did see was when New South Wales and Melbourne, so Sydney and Melbourne, basically had a spread of the Delta virus, we did see our incident rates per 100,000 move from 428 people to 670 people per 100,000 of that population. So simply that means that more people have had an infection of COVID because we're no longer doing lockdowns, and there was more of that spread. Okay, so we also know that based on the hospitalisation data, that 95% of the people who are presenting in hospitals are unvaccinated, and that's potentially the reason why we're also seeing higher death rates. So that is the cause of the movement from the 0.59 fatality rate to moving up to 0.68. Now that number may also increase given the reopenings and the whole concept that we're now living with COVID. What we also then need to offset that against is what we are definitely seeing is as our vaccination rates are improving, the contagion and the infections are actually coming down. So that's a terrific sign that it also reduces the spread of the virus and also reduces hospitalizations and ultimately deaths from that. So we've got to be mindful of that as well. Now, again, when you can comparing, where Australia is sitting in regards to our overall fully vaccination rates from total population, we're sitting at 65%. So we've still got some more work to do there. And as that rate moves higher, that's our counterbalance to the increased spread of the virus. So that's what the data is telling us in terms of how to best manage this. And that's what we're executing on. So Australia is going to hopefully mean no more lockdowns, and obviously coming into our warmer months, hopefully less spread of the virus, which we're now starting to see in what's happening in Sydney. And so that's only a positive sign as our two biggest centres are effectively moving to full vaccination rates in excess of 90% and hopefully moving more towards that 95%, which is protecting themselves, but also the greater population. If you're interested in following any of the COVID data, just for reference points, Johns Hopkins University and the New York Times vaccination tracker is where I'm pulling that data from. Okay, now turning our attentions to the world economic updates, starting with the biggest economy in the world, the US. We did see the US economy grew less than expected in the September quarter as supply chain issues and the pandemic throttled spending and investments. So GDP expanded by an annualized 2% after recording a 6.7% result in the previous period. Personal consumption tanked in the last quarter, rising only 1.2% compared to a 12% reading in the last quarter. And again, this has been thanks to the supply challenges and also mobility challenges, as we did see a spike during the Delta strain over in the US. That's now starting to settle down, so mobility is starting to improve, and that shows up in the October data that we've got. So consumer confidence rose in October following declines over the previous 3 months. Consumer confidence rose to a reading of 113.8, which was revised up from 109.8 in the September month. And this was above consensus expectation of a reading of 108. Now, improved employment prospects, which I'll get to in a minute, amid a recovery in the labour market and a fall in infections has boosted confidence, and confidence has recently been dented because of what we just talked about, those virus Delta strain infections, and also the concern around inflationary pressures. And that is one of the themes I'll be talking about throughout the course of this update. The unemployment story or employment story is interesting. Initial unemployment claims fell to 281,000 in the week ending October 23, and this is versus 288 expected by consensus. But this is the story that I wanted to highlight about the US, and that is that the real positive news on the jobs front is that the US Bureau of Labor Statistics are reporting that over 10.4 million job vacancies, that's right, 10.4 million current job vacancies. Now, this is the highest, one of the highest readings we've ever seen, coming off a peak of over 11 million only a month or so ago. Now, the long-term average for this particular reading of job vacancies normally sits at around 4 to 4.5 million. So you are definitely seeing labour shortages, and that in effect is part of the wages story that we are going to see play out, and what I want to talk more about in this update. In terms of the inflationary story, the other big news globally that we're challenged by. So the core theme of this month's presentation, I'm going to focus in on commentary from, basically key economic commentators in the US and also in Europe. Now, the first one I want to talk about is Treasury Secretary Janet Yellen, who also talked about her expected thoughts around price increases to remain high throughout the first half of 2022. However, she noted that she reflects temporary pain, and she expects inflation to ease in the second half of 2022 as supply chain constraints and labour shortages start to subside. And again, I want to talk more about that when I talk about the RBA announcement. Looking at China now. Now, China was the pin-up boy in terms of world economic powerhouse pretty much for the past decade and beyond. But we are now starting to see China's story is losing momentum. So let's take a look at some of the data. The GDP numbers on a quarter by quarter basis only grew by 0.2% in the September quarter. And this is on the back of power outages and shortages, continued supply bottlenecks in raw materials, sporadic COVID-19 outbreaks, and tightening restrictions on the property markets, which I also want to talk a little bit more about when it comes to China. So this 0.2% gain was on the back of a 1.3% gain in the June quarter. Now, compared to a year ago, GDP grew by 4.9% in the September quarter, down from 7.9% in the June quarter. So momentum is really being challenged here. So the broader challenges for the Chinese economy, these rolling outages and stoppages around energy and the costs associated with them, with producing that energy, high commodity prices continuing to impact, and that has a flow-on effect in terms of inflationary outcomes for that, a slowdown in control of the number of lockdowns, starting, stopping. And again, that inflationary pressure that we do see in terms of those inputs also then being reflected in terms of their exports. And that is inflationary for the countries that import those goods. And also that'll start to show up in countries like Australia, where we start to have import inflation coming into those markets. Now, the other big story here that I mentioned before was around the property story. Now, China has had an incredible boom, people moving into better property accommodation, and certainly property prices have reflected that over the past decade in terms of what's happening in China. Now, what the market is watching, and we've talked about this before, but this company called Evergrande, they have challenges around their $3 billion of debt that they have. Now, why we're watching this is because this is almost a quasi-read when it comes to the overall health of the Chinese economy. $3 billion in debt. Is this going to be a contagion that will see other developers start to be challenged in terms of servicing those debts? What happens to actual property prices themselves? What is the impact in terms of lending and defaults on the market? And then does that have that classic contagion effect into the wealth effect and consumer spending and consumer confidence? So watching this particular mega company and their debt and how they manage the repayments of those debt is really important. Now, what we did see last week is they did make two critical repayments. One surprise repayment, in fact, as early as last week, where they did think that there may have been a default on one of those repayments, but that has not materialized. So now the markets are going to be looking at what to next. That has bought them some time. Potentially they'll sell off some more assets and they'll start to get that debt under control. The other thing we're also going to be watching is, what will the Chinese government do here? Is this a situation of the risk that will then broadly spread across the property market? And so will the Chinese government step in to support them as they transition and sell some of those assets, so we don't see a major disruptions to the markets and a consumer confidence issue across the broader Chinese market, when they've already got those other challenges that we talked about in regards to energy, supply, and just general supply constraints and supply chain issues that pretty much the world is starting to address at the moment. So it's an interesting story and one to watch in terms of the Chinese economy, and obviously the flow-on effect to Australia in terms of iron ore prices, coal prices, and alike. The other biggest grouped economy in the world is the European market. So let's have a quick look at the GDP story for the September quarter. We saw GDP rise by 2.2% in what is their third quarter. They run a calendar financial year, which was above consensus of 2.1. So it beat consensus. And that was on the back of strong performances from France and Italy in those particular markets. On the negative side of things, for consumer confidence, we saw consumer confidence slide to a negative 4.8 in October from a negative 4 in September. As the move back into the cooler months and the winter months of the year is putting fears around energy prices and heating costs and potential increases of COVID cases, hospitalizations, etc. This is the long tail of the pandemic. But on the back of those higher energy costs and heating costs, inflation again is the story of the day. So we did see inflation rise by 0.8 in October to be 4.1% higher over the year to October. Underlying inflation was at its highest level since since 2002. It rose by 2.1% over the year to October, which was above expectations of around 1.9%. In another example of the central banks around the world trying to call the markets bluff and maintaining their important signaling on lower interest rates for longer, the European Central Bank's head, Christine Lagarde, pushed back on expectations of an ECB might raise rates before 2023, even though the latest reading on inflation does not support this view. She again reiterated that the current spike in inflation is unlikely to last. She describes the spike as largely transitionary in the euro area. She also vowed to continue to aiding the economy as the pandemic fallout lingers. But for now, again, the European markets are not agreeing with her, and they are again forecasting changes to interest rates on the back of this inflationary story. And that leads me into the conversation around inflation and what's happening in the Australian market. Firstly, I'll just acknowledge that the reopening of Sydney and Melbourne markets and the movement of people have led to a clear spending patterns, increases in personal care, clothing, hospitality. We'll talk more to that, but we do think that that economic bounce will continue as those restrictions are eased. The RBA again today met and at their Melbourne Cup board meeting, call it that, the race that stops the nation. They've kept the cash rate on hold at 0.1%, so completely no surprises there. But the real interest lies in the bond buying program. And to put this into context about how the market feels that the RBA has to move rates earlier than they're currently anticipating, which we all said was not until 2024, when they get wages growth and they get the unemployment number down, they'll start to move on that. Now, here's the context. The Australian physical bond yields spiked last week when the market digested the higher than expected uninflation data for the September quarter. The 3-year bond yield rose 10 basis points to 1.22, and the 10-year bond yield spiked 24 basis points to 2.09 last week. Now, the 3-year bond yield has risen more than 40 basis points since the publication of that underlying inflation data. And the yield on the April 2024, so to understand this, it's a 3-year bond, so that's why they're talking about what does the yield curve look like in 2024, 3 years from now, rose a further 0.78 of 1%, which is well above the targeted 0.1 of 1%, which is what the bond buying program is meant to do. So what did the RBA do about it? They did nothing. They literally last week couldn't match the market. And so the market moved that yield curve and they couldn't do anything about it. So it'll be interesting in terms of when we start to see the minutes of the RBA meeting today in terms of what story they're telling. So there will be more to add to that story in future updates that I supply to Empower Wealth or also on the Property Couch podcast. So stay tuned once we see their diagnosis there. But, ultimately, this is now an inflection point for the RBA. And what do I mean by that? Well, firstly, if we think about fixed interest rates, if those yield curves are going up and that bank swap rate is going to get higher, then we're going to see fixed rates for consumers starting to move higher, and they already have starting to move higher. So the window for fixing mortgages has been now, but I wouldn't be too panicked about the variable rate. And this is, again, just simply my opinion, but I wouldn't be too panicked about that, because what I'm now sort of, my thesis of this conversation now comes into this idea of what is the RBA going to do about tackling inflation, and what are they going to do about their big agenda here, which is, given that money is now cheap, they had an agenda to grow real wages. And this is their best opportunity to be able to grow those real wages, even on the back of the challenges that they've had now with inflation starting to show up in their numbers. So let's look at the inflation data first, and then I'll come back in terms of how I think they're going to counter these inflation numbers. So we saw inflation numbers released in the September quarter showed Australia isn't immune to this growing inflationary pressure that is impacting economies around the world. The headline measure, the CPI, rose by 0.8 of 1% in the September quarter, in line with consensus expectations to be 3% higher over the year. Now, trimmed mean inflation, which is the measure that the RBA prefers to use, also rose 0.7 of 1% in the September quarter to a reading of 2.1% higher over the year. Now, this was higher than consensus, which most people had 0.5 of a rise over that period. Now, herein lies the challenge. The RBA wanted to have that trim mean inflation band between 2 and 3%, and it hasn't been this high since 2015. Now, the problem that they have with that is they were forecasting that they wouldn't reach greater than 2% and to be within 2 to 3% until 2023. Now, we've also seen in the RBA's dialogue, and that is about consistently longer term in that bandwidth. This could be a temporary measure, and we could see as the supply chain issues start to settle down, that inflation also starts to settle down. And this is what I'm referring to as the ace in their sleeve. And I'll get to that. So we're coming into the challenge that we've got now is what is causing this inflation. So let's challenge or address that. The first thing is the housing boom is no doubt. We're seeing all costs of materials, shortage of materials, that's increasing input costs. Fuel costs are going up as basically oil prices and petrol prices continue to go up as we see strong demand as most world economies are coming out of their slowdown through the pandemic. And we're seeing these massive supply chain disruptions that I've been mentioning earlier, which is contributing to that inflationary pressure. In addition to that, we're also seeing a situation where the numbers look a little bit worse than they actually are. And this is because of the base effect. And what I mean by that is when you look at the 2020 data, the September quarter data versus the 2021, there was a lower reading on inflation because the pandemic was playing a role there. So you've also got to factor that into your calculations in terms of, is this a trend or is this just a one-off event? And will inflation come back to be under that 2% reading until such time as the broader economy and there's justification for that? So most economists still think that inflation will settle down as supply chain issues are addressed into 2022. And that's obviously the messaging you're hearing from the central bankers. Now, the ace up the sleeve is this story that I'm presenting in terms of my observation. And that is this, that we do know that for the last 2 decades, we have seen the RBA being very challenged about lifting real wages and getting those numbers higher. Now, this is effectively a once in a generation time where they can use the stimulus and the incentives and the printing money and all of the work they've done in regards to building momentum for a strong economy on the back of record high savings and on the back of low immigration, where they have the best opportunity in decades to lift real wages across the middle and the lower middle class areas. So are they going to go after that? That is the big question. Well, I think they will go after that. And I think that there's a really good reason why they should be going after that in this moment in time. And that is because we already know that there is a huge challenge around labor shortage. So once the economy opens up, that labor shortage will continue to put pressure on higher wages. In addition to that, we're also seeing that immigration has been curtailed. So we don't have this flood of immigration coming in to also provide that human capital that businesses are needing. So we absolutely get a sense that we will see unemployment dip even further lower as we hopefully stay open and we stay on top of the health issues and we control the pandemic through vaccinations. And if that is the case, then this is the best time ever, again, for the RBA to be able to do that. Now, of course, when you do lift real wages and when you have all of these demand pressures and cost pressures in terms of the input costs as you build your materials and your services and your products, that is naturally inflationary in itself. So the worry there is that we get some type of hyperinflation and the whole thing sort of, crumbles in on itself. And that's going to force the hand on the RBA to lift the interest rates the cash rate as well. So, and that will then slow down that demand and bring inflation under control. But I'm hoping that they continue to toe their hard line and until they start to see that wage growth coming through. And even though it is inflationary, the ace that they have up their sleeve and all the central bankers have up their sleeve is that they know one thing. The reason why they couldn't get real wages growth over the past 2 decades has simply been around technology advancement. So technology advancement through things like automation, robotics has seen vast improvements in productivity and also production materials and the advanced problem solving that technology allows us to do without using those human capital inputs. Now, the banks are going to realize that businesses will turn to technology once again to solve those problems, to reduce their business costs. And that will ultimately be good for inflation. That will bring inflation back in check over time. Now, depending on how much time that's going to take, well, that is the $64 million question. The question is, will inflation get out of hand too quickly versus when they start to move the cash rate higher? And that is the conundrum that they've got, because the signaling that they need to continue to do to the market is, we don't want to move the cash rate because we don't want to stop business confidence. We don't want to stop business investment. We don't want to stop that job story. We don't want to stop that immigration story of new arrivals coming in for the jobs, the pent-up demand of jobs that are going to be here. And that is a good news story for the broader economic benefit of the country as well. So if they get their timing right, which I believe they will, and they hold their line as long as they can for, and as low in terms of cost of finance, that is going to be a huge benefit and will set the economy up for a very, very prosperous time, as long as they can keep the inflation genie in the bottle. So that is the big news story that we're seeing here. And that's really the challenge of the Reserve Bank over the next 12 to 24 months in terms of how that plays out. So it's a massive agenda. This is a once in a generation time where they can really move real wages. And I think they want to, hopefully they will hold their line on that position. And then we'll see those supply constraints and the supply chain issues start to settle down as the world opens up, and inflation will start to reduce, which is a great news story. Real wages, low inflation means ultimately that our money goes further. And that's exactly what we want for every household in this country. All right, so that's my ace up their sleeve theory. In terms of the unemployment story, we did see labour force numbers for September paint a mixed picture. Naturally, September we're in big lockdowns, so there was a tentative sign of stabilisation in the labour market in New South Wales, while Victoria, obviously prolonged lockdown meant that we did see a big hit to jobs in Victoria. Across the country, unemployment declined by 138,000, driven primarily by 122,800 jobs lost in Victoria. The unemployment rate edged up only 0.1% to a reading of 4.6%. And again, we don't really look at that number. We look at the participation rates and the hours worked. So let's have a look at those. Participation rate sitting at 64.5%, which is the lowest reading since June of 2020. And that's why the unemployment rate still has a 4 in front of it, because people aren't looking for work. They will hopefully start looking for work now that we're coming out of those lockdowns. But also, there are definitely some really positive signs in the unemployment data that came through. And the first one is in terms of the hours worked, which again is a better read of economic output at the moment, increased by 0.9% in September, led by Queensland and New South Wales. Decline in jobs were also entirely driven by part-time employment, which fell by 164.7 thousand. So the massive story here is full-time employment actually rose in September by 26,700 jobs. The underemployment rate, which captures people who are employed but want more work hours, edged down by 0.1% to a reading of 9.2, while the underutilization rate edged up marginally at 13.9 following a sharp increase in August. So that's basically still saying we've got labour capacity there. We need to start using that. But again, I suspect once the economy opens and all of those people start taking up employment, we're going to see the unemployment rate fall quite considerably, so long as we remain open. In terms of the job ads, we did see Monday's reading, yesterday's reading, job advertisements in Australia rose by 6.2% month on month in October, and that's shifting from a 2.8% fall in September, and it was the first growth in job ads in 4 months. So again, opening up the economies, we're now starting to see those job ads start to materialise. So we expect employment will recover and the reopening of the economy will provide this relief for businesses. The unemployment rate is definitely going to start to fall below 4% by the end of 2022 is pretty much most people's predictions. So that is a really positive story. In terms of consumer confidence, the weekly ANZ Roy Morgan's confidence index for consumers is reading of 106, so there's more optimism than pessimism right now. That's also good news. In terms of business confidence, there's a really strong story here. Business confidence leapt higher in September alongside progress in the vaccine rollouts and the release of the reopening roadmaps that we've seen from governments. Business confidence rose 19 points to a 4-month high to be plus 13, putting it back in very strong positive territory and well above its long-term average. It's the biggest monthly gain since mid-2020. The business conditions, however, fell 10 points to be only plus 5 alongside the lengthy lockdowns in New South Wales, Victoria and the ACD. The conditions index is now just below its long-term average. We expect that to pop again. Business confidence is an encouraging sign. That's what I was mentioning there in terms of around, the confidence of willingness to hire and obviously willingness to invest, which is the two critical elements for economic prosperity. Retail spending data for September, remembering that we're in lockdowns, New South Wales, Victoria, reopening, all of that sort of stuff. Retail sales surprised and with a rise of 1.3% in the month to be 6.9% above the pre-COVID levels. The monthly index follows 3 consecutive months of falls as the Delta-related lockdowns impacted sales across the country. Queensland sales increased strongly at 5.2% to their highest levels, boosted by reopening of short lockdowns in prior months. Sales also bounced back in New South Wales, 2.3%, while the state was in lockdown. Sales continue to fall in Victoria, -2.1%, and the ACT, -12%, as both remained in lockdown during September. Sales bounced back in most non-food categories in line with easing of restrictions. Sales excluding food rose by 3.6% in the month, back to the pre-pandemic levels. And post the reopening, sales are expected to continue to bounce back as those restrictions get eased. Housing finance data that was released yesterday for the September 2021, seasonally adjusted, we did see total housing lending fall 1.4%, though the overall lending levels remain at very, very high rates. Owner-occupied housing fell 2.7% for the 4th consecutive monthly fall, as first-home buyers basically have already got their funds and doing what they're doing in terms of building their new houses. And the investor housing lending rose by 1.4%, continue its unbeaten period since October of last year as the investors start to move back into the market. We also saw in October the news that APRA introduced a serviceability buffer increase, moving the ratio from 2.5 percentage points to 3 percentage points. This effectively means it reduces the borrowing power by around 5%. So it is definitely a bit of a soft touch when it comes to impacting on the level of demand for housing. APRA has signalled that they do have potentially further work to do if required. And so we look forward to seeing the sort of tools that they're proposing to use, because it's a very delicate balance. You don't want to basically stop housing and construction because it will impact the broader economy. So you really want to basically try to get those levers right, which won't do too much damage to the broader economy. Property prices, again, a very strong story here. The CoreLogic data released yesterday shows that prices rose 1.49% in October, around pretty much the 1.5% that we saw in August and September, although it's slowly starting to ease back, from the March peak of this year, where we did see a reading of 2.8% for the month. nationally, home values are now 21.6% higher to the year of October, with half of the capital cities recording annual growth rates in excess of 20%. Again, the pace of growth is slowing. That is a good news story for a sustainable market. The first home buyers are out. General affordability is starting to bite in some marketplaces. Government incentives have been pulled back, such as home builder and some stamp duty incentives for first home buyers. And finally, obviously, the modest tweak by APRA will also be playing on the psychology of the buyer as well. What I take from that is this. What we will be seeing is the rising tide that's lifting all ships at the moment will start to now move into markets within market story. And we're still seeing some very strong demand indicators in certain property markets around the country. And so your job as an investor or a buyer is to potentially try to work out those demand and supply indicators, because there will still be some strong growth in terms of some of those markets around the country. Taking a look at the broader markets, we'll do a quick around the grounds. Sydney, growth of 1.5% for overall dwelling prices for the month. Melbourne, just under 1%. Brisbane, very strong at 2.45. Adelaide at 2%, very strong. Perth, a slight decline of negative 1.1. Hobart, very strong at 2%. Darwin, 0.42. Canberra, 1.94. So combined capital cities have a reading of 1.38. Combined regional centres, 1.87. Nationally, there's that reading of 1.49, just under 1.5. So we will start to see that story play out. Now, I also said at the start of my update, there was a story around new listings and the supply side. So I wanted to talk to that supply side story because it's important. And that's my theme for the property segment of this update. So we did see nationally, CoreLogic counted 47,040 newly advertised properties entering the market over the 4 weeks ending the 24th of October. Now that's up 22.7 on last year and 5.2% above the 5-year average. Now, new listings are now 47% higher than their recent lows of 4 weeks ending September 5. And you could almost put that in the Victorian camp in terms of basically their whole market being shut down, and New South Wales or Sydney, even though you could transact, very difficult to get out and see those properties and transact as well. But what I said in terms of the intro of this story, there's more to this. There's more to these numbers. So, in terms of the total listings, we now have 141,786 listings. And, that is still, 20.8% below the listing numbers of last year. And on a 5-year measure, it's 26% lower than the 5-year average. So whilst it's great to see these new properties coming on board, it is also meaning that we are still low, we still have historically low levels. So what's my reading on that? Stock levels, whilst improving, are still not at the levels that we are going to allow the market to come back to equilibrium anytime soon. This means, generally speaking, that prices are going to continue to rise through 2022, especially on the back of improving economic conditions. Hopefully we see that wages growth coming through. And finally, the immigration story as we start to open up, which will then see, obviously, vacancy rates, rental demand, just general accommodation demand starting to be tighter and tighter. And so it's for this reason that I eagerly await the paper that APRA is going to release around what other tools or what other thinking they have around what to do with the property market in terms of ensuring financial stability in the lending space, because property is making up a big aspect of the lending that's going on at the moment. So there are going to be some interesting ideas, I suspect, in that paper, but it's going to be very, very delicate in terms of what they need to do. So if they're seeing property prices are starting to come down, that's a good news story for them. Hopefully they won't have to do too much radical adjustment, but it also could mean that we might see some more attention being put on in terms of treatments around investments, around maybe loan book growth for investors and those types of things, to just slow down the amount of investor activity that might be coming into the market in light of the smaller increases that we're seeing in terms of owner-occupied demand and so forth. So that's going to make for some interesting reading when we see that discussion paper released some point in this month, or hopefully before the end of the year. So as I close out this month's economic update, these are the summary of my thoughts. Wages growth is coming, and the RBA hopefully will get their wish in terms of delivering on that, whilst also, looking at inflation. Inflation will also be present, so we need to understand that it's going to be around, but hopefully they can use technology as their driving force in terms of being able to curtail the inflation pressure. Also, when we start to see immigration start to roll in, so that's going to reduce labour shortages, and hopefully those supply chain issues that we're seeing globally will start to organise themselves out. And finally, when it comes to the property stock story, just be mindful that you're going to have to start measuring demand and supply at that sort of market level, because there will be seriously some unbelievable opportunities again in 2022 when it comes to the property market. The next 12 to 18 months is going to be an interesting time indeed. So, lot to cover off in November. It is always the case. It's on the back of quarterly data that comes through for the September quarter, a reopening of the economy. So it is interesting time. So I'm hoping you hung around till the end, because there's a lot to consider there. But it really is now in the sort of RBA's hands in terms of how they start to think about their levers and what they're going to do, whether they're going to hold firm and keep the cash rate lower for longer to allow for that wages growth to start to materialise, and then confidently predict that inflation will start to ease over time. So there you go. So until next month, my final update, December will be my final economic update for the year. Knowledge is empowering, but only if you act on it.